Hey, Shauna, welcome to the show. How is it going today?
Absolutely fantastic. I'm in Arizona and it's not 120 anymore, so I'm really happy about that.
So there was this length of time that you went with. It was like a record length where there was consistently three-digit
Yes,
heat,
over
right?
100, and I think it was 100 days over 100. So lucky us, we're beating our own records. How exciting. So yes.
Wow, wow. So it is cooling down here a little bit. Actually, I'm in the southeast. We're recording this just before election time here in 2024 in the end of October. And we've got a little bit of heat hanging out here. We're still rocking and rolling. Real estate is doing what it does, which is, hey, some people like it, some people don't. But the other thing that some people like and some people don't is taxes, right? And how that relates to real estate. Oh, for the physician listeners out there today, we've got a lot to talk about, Shauna.
I love it. I'm looking forward to it. Details are my favorite. So
Yes, so let's just get started by I always like to give the listeners just a little background on who you are and what are we doing here?
for sure. All right. Well, I don't know how much background you want, so I'll start big picture. So I started off in astrophysics and became a tax goddess. Now, the big question is, where tax goddess? You know, that's great. That's a great title. We love it. But what are the statistics, right? People always want to know the numbers, at least in my world. So when you look at anyone dealing with tax strategy, there's kind of a pyramid of knowledge, right? So we have 660,000 CPAs, according to Google. Of those, 60,000 with masters in tax, right? So we're starting to specialize in the tax world. You get 807 certified tax coaches. Of those, there's about 230 that are certified tax professionals. And of those, there's about 15 that are certified tax strategists. So we are the top of 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 the strategy food chain. We're actually ranked in the top 3. They refuse to tell us who's number 1, but I've spoken to the other 2. So I think I have a good idea. All the good bets. So yeah, and really, you know, our passion, what we do for people is save taxes legally. So this year we're at 1.68 billion and counting for our clients. I think the easiest way to think about it is you're layering strategies on top of each other. Okay, so for example, I mentioned some of what we call the low-hanging fruit, right? If you have kids older than the age of 7, you should be paying them. This year, 2024, that dollar amount should be around $23,000 per child to get it completely tax-free. So if you've got 2, 3, 4 kids, right, that's a nice chunk of money right off the bat. Master's exemption, sometimes called the Augusta rule. Okay, this is where you can rent out your home to your business, right? It's one of those fun little real estate tweaks, right? You can rent out your home to your business and pay whatever the fair market value of rent is as a deduction. So your business gets a deduction, you pick it up as income, but it's non-taxable to you under the Augusta rule. So on average, you know, the rental rates range anywhere. The lowest we've ever seen was $500 a day. The highest I've seen yet is $26,500 for an apartment in Manhattan per day.
Wow.
So yeah, depending on where you live, you know, these can be really big numbers, $150,000, $200,000 a year of tax deductions. So, of course, we always hear about the cars. When you're really, you know, buy a car, get the whole write-off. We're depending on who gets into politics. I don't like covering politics, okay? This is all about the tax. But depending on who gets in, we're hopeful that we'll go back to a 100% depreciation level on the purchase of new cars. So, you know, the big SUV kind.
That's section 179, correct?
179 allows it 100%. You also get the 168K. And that is really what people are kind of antsy about. At the moment, the 168K is between 40 and 60%, depending on which year you buy the car in. They're hoping to bump that back up to 100%. 179 is great. You get the full write-off, but you have to recapture the depreciation. 168K, you may not have to if you do it right. So everybody's kind of fighting. They really want that 168K to go back to 100%. So depending on what you're doing, okay, when we talk about minimum requirements, normally the best tax deductions are going to be in one of three categories, okay? Either you have a super high W-2 and you have cash to invest. So normally we look at least $300,000. Okay. If you are not a W-2, if you're a business owner, and I'm going to split business owners into real estate business owners and then other business owners, right? Everybody else, okay? If you're a general business owner, that is perfect because you have the opportunity to create ordinary, necessary, and reasonable deductions for your business, all right? Now, you have to be active in the business, okay? So we've had people buy a business and now they're a business owner, but they're passive, they don't do anything with it, they don't make any decisions. That's not going to get you any tax write-offs.
That's where you want them to be back in that second bucket with having real estate, with passive losses.
You got it. You got it. So really when we talk to a client, right, especially somebody that maybe was a W-2 or is and is looking to get into something on the side, so real estate investing, what are your goals? What is it that you're trying to get to, right? If you want purely passive income, you're not going to get the tax write-offs. Right? Then we have to look at the investing options, right? That $300K to $500K worth of cash. But if you're willing to put in a little bit of effort, or in a perfect world, you're married and one spouse earns the money and the other spouse can go, for example, be a real estate professional or run the Airbnb, the VRBOs, put in that extra concierge level service to create it as a business. If we've got somebody else that we can play tax games with, it's much, much, much easier to reduce the taxes for the overall family. So if we're looking at the real estate side specifically, we are now looking at, okay, well, is this person active, passive, or real estate professional? One of those three, okay? And there's two extra ones. There's two little bonuses that most people don't catch. They don't really kind of understand. Number 4 is this Airbnb, VRBO, short-term rental with concierge level service, okay? Now that terming comes from the IRS specifically. Imagine the old version of the Airbnb, right? Where you would go, your bed and breakfast maybe is the best way to think about it. You'd go, they'd make you breakfast, they might drive you to the tour that you're gonna go look at, right? They're giving you that extra level of service that really converts a rental into a business, okay? So that's something the IRS allows. And the 5th one, of course, is the aggregation election. Now, this is really handy if you have a business and your business is going to go into a building that you own. Okay, this is one of the few cases where somebody that, let's take a physician, for example, you've got your practice, maybe you're renting a building. You may want to buy a building because if you move your physician's practice into the building you own, you can actually do cost segregation and do an aggregation election and use the cost seg costs to offset the depreciation, to offset your business income. And it's one of these rare little kind of loopholes in the code that most people don't know about, and you only can use it the very first year that your business moves into that building. So if you bought a building last year and your CPA didn't write it off, I'm so sorry you missed it, right? The aggregation election is one of those, it's got to be done on time. So there's some pretty fun things. There's multiple versions of an installment sale. The one that's going through my mind is installment sale trust. So let's just give, for example, your house didn't burn down, okay? You just want out of it, okay? You have a big gain. You don't want to pay tax on the gain. You don't really want to get back into real estate. You want to do something else with it, okay? You want to buy a Subway franchise. I don't know, whatever it is you want to do with the money, okay? An installment sale trust allows you to put the gain, to trap the gain inside a type of trust, installment sales trust, and you only pay tax on that money if you take the money out. So as long as the money is still in the trust, it can invest in other pieces of real estate. It can invest in a Subway franchise. It could invest in anything that is a business that will make money. So it could invest actually even into your own business, okay? If you own an active business, it could become a partner in that active business, okay? So there's a million ways to spin that if it's before a transaction occurs. Once
it sounds like captive insurance.
Very similar to captive, right? The money is inside an entity and you can borrow it, you can do things you want to with it, but you have to maintain a certain chunk of it, typically 30% inside the trust. So, yeah.
Similar to, and again, similar to like a self-directed IRA until you mentioned you can invest in your own business, then that's the difference maker there.
Yeah, you can't, no self-dealing on the IRA side, so yeah.
This is some high-level stuff, huh? Man, come on with it.
We are definitely strategic tax coaching, okay? Our job is more the coaching. What to do, when to do it, how to do it, okay? So we have a meeting once a month with every single client if they want it. Some people are, no, I got it, we're good, whatever. We have a meeting once a month with every client to go over, these are the things we told you to do. What questions do you have? What questions does your CPA have? Like, we can be your CPA, so if we're not, right, let's work with your CPA, let's work with your lawyer, let's work with your real estate agent, let's work with your banker, okay? One of the biggest problems, I'll be very upfront, that people run into with using a service like ours is that it's our job to make you look poor. So if you're trying to get loans from a bank, you're effectively unfundable, right? Unless your banker understands, what are we doing? What are the add backs? Captive being a huge one, right? I mean, that's $500,000 expense in the first year. If your banker doesn't know what they're looking at, you're not going to get any loans to buy real estate.